Good afternoon, public community, and welcome to another exciting afternoon session. Today, we're going to be breaking down why economists look to oil prices as signals for broader economic trends and unpack what, if anything, oil can tell us about the likelihood of a recession. As I'm sure many of you all know, the price of oil has been especially relevant in the current economic backdrop. Energy prices, they have proven to be incredibly sensitive to supply chain disruptions caused by Russia's war in Ukraine, which has led the energy sector to be the best performer in the S&P 500 this year, while also dramatically increasing the cost of fuel for corporations and gas at the pump for consumers alike, which I'm sure we've all been feeling some of that pain. So what does historical evidence suggest about what we can expect in the coming months, and how much of a grip does the Federal Reserve have on the direction of the economy? With those questions floating in our minds, with us now to dig deeper is Phillip Braun, clinical professor of finance at Northwestern University's Kellogg School of Management. Phillip, welcome to Public. Oh,
thank you very much. Happy to be here.
Oh, perfect. Phillip, you know what? I love that. First of all, you're a clinical professor of finance, which I'm assuming means that you guys actually really dig deep into the theories behind financial trends. So I'd like to first start with you by zooming out on how does the current price of oil compare, in your opinion, with what we're seeing early in the Russia-Ukraine conference, and how does it compare to the historical averages?
Price of oil has come down since the beginning of the war. After the war started, actually before the war started, oil prices jumped up 70-80% per barrel on the global markets. Today, they've come down from 120 to around somewhere around $100 per barrel. So the situation is not as bad as it was 2-3 months ago. Historically, the price of oil per barrel right now is actually lower than it was in 2008 when it hit a peak. But historically, what we're seeing right now is similar to price spikes we've seen in oil going all the way back to the 1970s when we had issues with OPEC. So it's really not a new phenomenon.
Even though the phenomenon isn't new, I think a lot of people out there, regular, everyday retail investors, consumers, I mean, perhaps they don't always have the historical gauge that you have. And they say, hey, in 2008, per barrel, it was even higher. I think for a lot of people, when they see oil prices move, Phillip, it's common for them to see commentary around what the implication areas are for the economy. So I would love to know, in your opinion, why is oil a signal that people should be paying attention to when it comes to understanding the overall health of the economy?
There are different perspectives on this. I'll give you my perspective. So the issue with spikes in oil are they feed directly into inflation, and they can push inflation way up. Also, oil is a major input to many products, and it pushes the price of those products up also. And so those are the two major impacts. A lot of people think that rising oil prices push the economy down, slow economic growth because it's a major input price. But actually, I studied this, and what I've seen in the data is that it's not oil prices spiking that cause the economy to slow down, but it's the Federal Reserve's actions to those price spikes that push the economic growth down.
I love that you brought up the Federal Reserve, and actually, I also love your most recent column that you shared in Forbes that offers some important nuance, right, to this overall conversation. If you think that the Fed's policies are, a real contributing factor to what's going on in the control and direction of the economy, and not just oil, what value, if any, does following oil price trends actually have? Can you just share some insights that perhaps you or economists and investors can derive really from tracing these oil prices?
Really, rising oil prices uh, again go directly into inflation, and inflation is a major issue for the economy. And it's the Federal Reserve's response to this rise in inflation that caused the economy to slow down. So, for example, I first started studying this when I worked for Ronald Reagan's Council of Economic Advisors back in the 80s. So there were energy prices rose in the 1980s, but nothing compared to what we do now. But the study showed that when oil prices go up, inflation goes up, and then the Federal Reserve responds to the rising inflation by increasing interest rates. And that increase in interest rates then is what drives pushes the economy to be slower. And I've checked on this study since then many times, and and they all show the same thing. It's the rising interest rates that the Federal Reserve introduces that really causes the economy to slow down, not energy prices per se.
Even though the Fed, even though oil prices, they're not the only reason, right, that the Fed feels like they need to do this monetary policy tightening right now and become much more hawkish in their approach to tightening up interest rates. Perhaps oil plays a role somewhat. I know that also in your Forbes article, you mentioned basically the historical look, which you also referenced here, working with the Reagan administration, about rising oil prices specifically though, and how they correlate with incoming recessions. I call recessions the dreaded R word because most of us investors here on the platform are part of this community, right? The only recession that we've really lived through was the one that kicked off in 2007, beginning of 2008, which lasted much longer than the typical recession cycle does, but that's the only one that we can really draw context from. So back to this, these relationships create maybe a misconception that it's a casual relationship. Can you just talk about why you think this may be an incomplete view of what's actually happening?
Yeah, it's an incomplete view because other things, of course, are happening in the economy. And what we see in the economy today is reflective of what the U.S. saw in the 1970s. In the 1970s, we saw oil price spikes and we saw food price spikes. And the same thing we're seeing now. And it's in response to these that the Federal Reserve acts by raising interest rates, maybe reducing the money supply, and that slows the economy down. So a lot of people say, well, no, oil prices are spiking, so the cost of inputs to production are rising, and hence people are going to slow their consumption of these products because their prices are going up. And that's only partially the story. It's really the Federal Reserve's actions that ultimately are slowing the economy down, and that's what we see today. Prices of oil has gone way, way up over the last 6 months and pushed inflation up with it. So inflation in the U.S. today is around 8.6%, very, very high. The Federal Reserve is acting to push the inflation rate down. They're doing this in two ways. One way is increasing short-term interest rates, and the other is by reducing the money supply. Now, a lot of economists, so the big question for the Federal Reserve today is, well, as they push interest rates up, is this going to push the U.S. economy into recession? Economists can't agree on an answer for that. My prediction is, yes, they ultimately will lead to a recession. As interest rates go up, they're going to have to go up again, and they're going to have to go up again, ultimately to bring inflation down. And they're going to have to rise so much that ultimately the Federal Reserve's actions will push us into recession. What kind of timeline we're looking about really depends. My perspective, the Federal Reserve is not being very aggressive right now. That interest rates they're probably going to have to raise interest rates to 5 or 6% to bring inflation down, and that ultimately that level of interest rates will push the economy into a recession.
Well, the Fed pushing the economy into a recession, I guess that kind of answers my next question. If interest rates, if they're raising to 5 to 6%, I mean, do we really think that the Fed is achieving a soft landing with the economy at this point, regardless of how we get into the recession?
They're still trying to achieve a soft landing. That's why they're only going to increase interest rates this calendar year to 3.5%. But my perspective is that won't be sufficient to bring inflation down. And next year we'll see interest rates rise even higher, 4, 5, 6%. Ultimately, hopefully, bringing inflation down.
Let us hope so. I'm kind of thinking right now, I'm like, gosh, just have you shared this information with Jerome Powell and some of the other Fed presidents so that they're well aware? I'm sure they have very smart people in their teams, but you're making a lot of sense here today. Let me get one last quick question in for you, because this is an audience of retail investors right here in our public community. Of course, they follow economic trends closely. So do you think it's important for investors to have a pulse on economic signals in general, and how do they impact the markets and perhaps ultimately our own individual portfolios?
The market has already tumbled quite a bit this year out of expectations that the economy is going to slow. The question is, has the market tumbled enough to incorporate the real degree of economic slowdown that we might experience next year? That's a very difficult question to answer. Not all economists are predicting a dramatic slowdown. Not all economists are predicting interest rates are going to have to be pushed really high. My perspective is they will have. And then adding on to that, therefore, I question whether this year's market decline are sufficient to reflect the true level of economic slowdown that we're going to incur. They might not have. So investors therefore need to brace themselves possibly for further market declines into next year. We're definitely going to see volatility in the markets. That's not going to go away. But are we going to potentially see continued market declines? My opinion is yes. So investors have to protect their portfolios. They have to prepare themselves for these potential declines. And you can do that different ways. But one way, of course, is to add bonds to your portfolio. But again, with rising interest rates, bond prices are going to be very volatile. So it's a very difficult market to decide how to go forward. Given the level of inflation, one has to ask themselves if it's better to have your money in cash than in the markets. And I think that's an important point for investors to think about.
Yeah, Philip, I guess that goes back to the old saying, cash is always king. Though when the markets were on a tear upwards, people were saying cash isn't king. You need to invest your money. You're going to get better returns in the markets. But perhaps there is a reversal of that, going back to that saying about cash being king. And I'm so glad that you joined us today. Thank you so much for sharing your insights about oil, about the economic indicators, and about the likelihood of a recession. Everyone, once again, this is Phillip Braun. He is a clinical professor of finance at Northwestern University's Kellogg School of Management. Thanks for joining us.
Thank you. Bye-bye.
All right, everyone, that's going to do it for this afternoon session right here on Public Live. Thank you guys so much for joining, and have a great day.
If you would like to see more content like this, subscribe to our channel and download the Public app where you can listen to these sessions in live time.